Hey guys, it's Zach here and welcome back to your Whiteboard Monday. I'm excited because if you've been following us all month long, then you're very aware that we've been talking about funding your deals. And where do we get that money and how do we get that money? And a bunch of different things we've talked about, especially in the last Whiteboard Monday, but we also covered in the last Whiteboard Monday all about hard money lending and why and where and what you should be looking for and how to structure that. Well, today's Whiteboard Monday is all about private investing. So this is what we're going to be talking about. Private funding. And why is it important? Well, private funding is the bloodline to the growth of your business. If you want to move from a Tier 1, Tier 2 investor into a Tier 3, Tier 4, then you have to be able to go out and secure private funding. It's going to be the bloodline, and there's so many cool things that we can do with it. So I want to jump right into this Whiteboard Monday, and I want to talk about why they fund it. So why do private investors fund your deal? Well, they fund it because they can typically get between an 8 and a 10% annualized return on their money. So most private investors, they've got money sitting in a stock market, they got money sitting in a savings account, they got money sitting in a mutual bond or something like that. It's probably only yielding them anywhere from 0.5% to maybe a 3% annualized return. Okay, that's annualized. So what I want to point out there is that is annualized. That's on a fluctuation of the bond market, or maybe it's connected to the coffee index or whatever the index that they're fluctuating their returns on, and that's an annualized return, and it's just not that attractive to them. Well, if they've been educated on real estate at all, then they know that their property is the security to their loan. So meaning that if I'm going to fund your deal, well, what is my security that your deal is going to make me money? Well, one is it's based on the interest rate. I'm going to get an annualized interest rate which says I'm going to make X amount of money on deploying my capital into your deal. The second thing is I'm secured by your piece of real estate. So what does that mean? That means if something was to go wrong, I could acquire that piece of real estate back, I could sell it, and then get my profits back or my investment back. So they do it because it's a higher annualized return. The other reason they do it is because it's secured. However that comes out, I don't even know if you can read that, but that says secured. The other reason is it's secured. So what does that mean? Well, they typically want 70% or below on that loan. So if you've got a $100,000 house, they're going to loan you up to 70% on that property, which means that if they do have to take it back, well, at least they've got a 30% window that they could sell it quickly and make their money back, or even make a profit on it. And that's really why they do it. Now, I will express this to you. If you're going to work with private investors, just make sure, make absolute sure that your private investor is taken care of and that you make sure they get paid even before you get paid. You want to always know that your private investor makes money. And listen, in some scenarios you might have to lose money so that they make money, so that they'll come back and fund your deal again. That's the big thing here. Now, not all deals go well. Some take longer to sell, some take shorter to sell. It just really depends on the market and how fast you can get it to move. But this is really why they fund, is because of this type of interest rate, and it's secured by a piece of property. Now, let's talk about this one. Who they fund to? Well, they fund to people either A, they have a relationship with. Most private investors you know personally, you have a relationship with, they trust in you, unlike the hard money lenders out there who only fund based on the deal, and that deal could be because they only have interest in that deal, where a private has interest in you. Now, you may cultivate relationships with private investors over time that do see the benefit of working with you, and in that case you're going to build that relationship with them. But who do they normally fund to is investors who have a track record. They're going to want to know either A, you've done it before, or B, you have the team in place, or C, that you're getting started, but yet you have the education and the support behind you to make it happen. And so we have to build that confidence in them by educating the private investor that we are who we say we are, we do what we say we do, and we can make this happen. And the way we can do that is by simply educating them on our deal. So who do they fund to? people they know. Okay? So we have to build that relationship with them. Now there is some guidelines when you're going after private investing, which states that you have to have what's called 3 points of contact before you can work with a private investor. Those 3 points of contact have to be done within inside 30 days. So if you meet someone that could be a potential private investor, within 30 days you got to have 2 more points of contact with them before you can start talking to them about how you're going to use their money, what you're going to deploy their money on, what type of returns they can get. We have to have what's called an established relationship or a pre-established relationship before we go into private investing with them. Now, what they look for, this is key. They look for good deals in good areas. And why do they look for that? Because that's what you need to bring to them. Don't bring them a deal that just because you found a deal and it's $40,000 and it's worth $80,000, needs $20,000 in repairs, but yet it's not in the best location. You're doing yourself a disservice and them a disservice by doing that. Only bring them good qualified deals that meet your market segmentation so that you have the research to be able to bring to them and tell them why that deal is a good deal and the comparables to make that happen. Okay? So what they look for is that. They look for good deals and they look for you being honest with them about those deals. Now, let's talk about the paperwork and the structuring of the deal. So let me jump over into that for you. I hope this month is helping you guys understand what all goes into working with private investors. So let's talk about the paperwork. Okay, so we're going to go into the paperwork. Now, a lot of people get really confused about this because it's really not that difficult, okay? The primary paperwork we need is what's called a promissory. A promissory note, okay? The promissory note is what outlines everything that we agree on. It outlines terms, conditions, when payments are going to be made, interest rates, who's liable for what, when things are going to close, a timeline, an effective date. It goes into all these different processes of understanding why the loan is being made and when it's being made. That's called the promissory note. That promissory note, well then it goes to either the equity trust company, the ETC, which is equity trust company, who most self-directed IRAs are positioned with them, so that they now know how to distribute those funds. The other thing it can go to is your closing office. Okay, your closing office could be your attorneys or your title agencies. That what happens is that promissory note goes to the closing office or the attorney, and then what happens then is we get what's called a mortgage drawn up. So we go from a promissory note to a mortgage, okay? The promissory note outlines what I and you agree upon as a transaction for you to fund our deal, and then the mortgage is drawn up by the attorney that secures the private investor's position in that property, whether it be by first lien position or whether it be by second lien position. That's what this is all about. The mortgage gets drawn up, and that's drawn up typically by the attorney. Some cases, ETC, Equity Trust Company, will want to see the mortgage ahead of time before they fund. And that's okay, because we can draw outlines that say simply that if funding doesn't go through, mortgage is null and void. Okay? But that's really all we have to do is a promissory note and a mortgage. That secures everything. Now, in some of the other paperwork, they may want an insurance policy. Okay? An insurance policy, let's say you're borrowing $80,000, well, they'll want an insurance policy for $80,000 where the private investor is the beneficiary of that insurance policy. So why is that? Well, God forbid something happened to you. Well, now the private lender has to sit through probate and wait it out to figure out who's going to get what. But if you have an insurance policy that pays them out, well, then they don't have to sit and wait or wonder what's going to happen. So this is very important for you to understand this. The other side to this is that once this insurance policy is put in place, you can get it approved by the private investor, and they can say yes or no to that. On the other side of it is they're going to want to see insurance on the property. Okay? The insurance on the property is what's going to allow them to know that if something goes awry on that property, their investment is covered on that property. So, needless to say, the paperwork is very simple. When you think of it, it's not that difficult, it's not that obtuse, it's not overdrawn, it's just very simple. Here's the paperwork that we need in place. A promissory note and a mortgage to secure. The promissory note outlines all the details inside the loan. Now, I also want to take you through the structure, okay? Because I want you guys to be very clear on what all this looks like. So when we talk about the structure is really more or less talking about the loan in itself, okay? So let's talk about this. So the structure is in the promissory note. So let's talk about the promissory note. The promissory note has to have who the payee is, and it has to have who the lender is. So who's your lender and who's the payee? Is it you, your company, or whomever? It also has to have terms. So what's the terms of the loan? Inside the terms, you're going to have length, you're going to have start date, you're going to have interest, and you're going to have payment plan. And all of that is going to have, basically, this is going to consume what we know is the note, okay? So what's the length of the note? Well, I'd like you to let me borrow money for 6 months, okay? What's the start date? It starts April 1st. What's the interest rate? We're going to be at 8% interest on this loan. And what's your payment? Well, 8% times whatever the loan is divided by 12, right? So let's use simple math. Let's say we say the length is 6 months. The start date is April 1st. The interest rate is 10%. So on a $100,000 loan, we've got roughly 10% of that's $10,000. So you're looking at what? A little over $800 a month, okay? That's what we're looking at when we structure the terms of that loan. Also in your promissory note, it should have in there like maybe a payment penalty. You know, if you don't make your payment on time, there's a $5 a day payment penalty that you incurred that gets paid to them. On top of this, you also may want to have something about legality stuff, that if this note is not being sufficiently taken care of by the borrower, then the borrower could be entitled to legal actions. And so you can put in there that that all legal actions should go through mitigation first and at the buyer's expense, the borrower's expense, okay? So that allows you to mitigate anything that if it was to go wrong. So that's really about the terms. Now, here's something else I do want to point out to you. When we're talking outside terms, we also want to talk about payment structure. Okay? Payment structure can be done either monthly, it can also be done at time of sale, okay? Or it can be done quarterly. All right? So let's talk about these. If you borrow money from a private investor, you could put in your promissory note that you're going to make your $800 a month payment every month until it sells, right? Or you could say, well, listen, I'd like for you to roll 6 months of my interest payments into the loan. So if we're looking at $800 a month, that's $4,800 into the loan. So if you're borrowing $60,000 plus 48, so you're borrowing $64,800, which means now your interest payments are getting interest added to it. But at the end of 6 months, you owe $64,800. That means that the lender is actually making more interest rate because they're charging you interest on the interest payments that they put out there. Now, one of the things that we do more than anything is quarterly payments. So what does that mean? That means if I borrow money on April 1st, you got April, May, June. So by July 1st, I owe my first payment of the 3 payments. This number is wrong. I'm sorry, guys. 8 and 8, 16. It's $2,400. So it's $2,400. So it's only a quarterly is, or Or no, I'm sorry, not to confuse you. Don't even worry about what I just did there. So quarterly payments is basically 3 months of payments, okay? So what we say there is we say, okay, Mr. Lender, my payment to you is $800 a month, but I'm going to pay in quarterly payments. So that means every quarter I'm going to pay you $2,400. Now, why would I do quarterly payments? Well, here's why. Because if it takes me a month to rehab the house, now I got 60 days to get it sold before I ever make any payments. So if I sell it within inside that next 60 days or inside that 90 days, well then my quarterly payment of that $2,400 actually comes out of the closing. So I never had to come out of pocket any money. It comes out of the profits of the deal. So it's really like a no money down deal for me because I can borrow the money to do this. Now, that is on payment structure, okay? I want you to be clear on that. You have 3 choices, right? You can either pay monthly, you can pay quarterly, or you can have the interest rolled into the loan, okay? Now, the other thing I want to talk to you guys about is not so much the payment as it is the types of private investing we can do, okay? So, oh, by the way, in your promissory note, you should have what's called an extension clause, okay? So an extension clause that just simply says that this note is for 6 months, but I have the rights to extend for another 6 months, okay? Which gives you a year to sell the property. Now, when we're also outside of payment structure, when we're starting to talk more about the types and the ways we can work with private investors, we really have 2 ways, okay? So ways to work with your private investor, okay? So number 1 is an interest loan. Number 2 is an equity partner. Okay, so let's talk about these 2 different things. So on an interest loan, that is everything we just talked about. There's an interest rate, there's terms, there's payments, there's a start date, there's an effective date, all that's inside an interest loan. Why would this be beneficial? Well, because it's secured. It's security. They know they're going to get their payment. They know their interest rate and so forth. An equity loan or an equity partner is someone who comes in to fund your deal based on an equity position. So what does that mean? Well, you could pay out anywhere from 25 to as much as 40% of the deal, right? On an equity position. So think about this. So if I'm bringing a partner in and that partner is going to be an equity partner and they're funding the deal, well, that means that they're in the deal with me. There is no payments, there is no interest rates, there is no effective date, there is no end date, there is no extension. It's just, hey, when this deal sells, then we will split up the net proceeds as we've outlined inside our equity partner, which basically all of this is still outlined in your promissory note. They still want to be secured, so it's in the promissory note as well. Instead of interest rates, it's an equity partner position. Now, what's the benefits to you? Well, if they're an equity partner, you never have to worry about payments, you never have to worry about interest, you never have to worry about effective dates, you don't have to worry about any of that. It's just, it's done, it's on the market. When it sells, we both make money. Now, what's the benefits of these 2 for a private investor? Well, obviously the interest loan is just that. They're secured, right? They have an interest rate, it's locked in, they know they're getting paid. The benefit for an equity partner is they can make more than they could have ever made on an 8% annualized loan. Why is that important? So let's say they're loaning you $100,000, okay? And that $100,000 gets lent to you as an equity position on a property at 25%. Let's say you profit $20,000 on that deal. Well, they get $5,000 of that. Now, if you take that on an annualized interest rate, it's really not that much, right? $100,000 to $5, that's like 5% interest rate, right? But that's not where it comes into play. What comes into play is let's say that with this equity partner, you took that $100,000 and you did it 3 times that year. You put their money into the market, you made $20,000 back, you gave them $5,000, you deployed it again, you made another $20,000, you gave them $5,000, you deployed it again, you made another $20,000, you gave them $5,000. So what's their annualized rate of return now? Well, now it's $15,000 that they've made on a $100,000 investment. So they're at a 15% annualized return. The beauty of the equity partnership is that they can, not saying they will, but they can make a higher yield of an annualized return being an equity partner. Now, the downside, right? Let's talk about the two downsides. The downsides to an interest loan is that it's just fixed. It is what it is. The downsides to an equity partner is that it's not fixed. What does that mean? That means that you could make 20 or you could make 10 or you could make 5, right? They're in it with you. They're in it as in what we say a high yield return, right? They're shooting for the high yield return, but they could miss it based on the market and the property. So we have to take in the good and the bad and always explain this to your investors. I explain this to all my investors. I will tell you that about 70%, it's about a 70-30, 70% of all my investors take the equity partnership. They just do. Because they have a higher chance of making a higher yield return over the annualized basis of that loan. So this is some of the process that you want to think about when you're working with private investors. Now, they're not all going to understand equity partner, but you do a good job of explaining it, you probably get a better chance of getting them on board with it. But at the interest rate, they're all familiar with that one. That's going to be very easy for you. So, guys, I hope this helps you understand private investing. Typically, what you're going to be looking for, 8 to 10% is an average loan rate for a private investor. But understanding the structure, the paperwork, the terms, the payment structure, the extension clauses, the ways to work with your private investor, the interest loans, the equity partner positions, there's a bunch of different ways to make that happen. You can also work with private investors on one side of the whole equation, and that side is that you get them to fund the whole deal. I'll show you an example in our Inner Circle training that's coming up this week. Is an entire case study about a deal that we did that we used private money and we had them fund more than the purchase cost. So what happened? Well, I walked out of the attorney's office with a check for $15,000 so that I can do the remodel with that. And that's what you want to pay attention to, is how all that looks. So you want to watch this coming up webinar on the Inner Circle training on the deal that I'm in the middle of working on and how that works. Now, the beauty of it is those of you that are coming out next month for our live in the field training with me, you're going to see exactly how we do that. You're going to see exactly how all that transitions. You're going to see how we look at the markets, how we pick the markets. You're going to see how we work with private investors. I'm actually going to take you out and show you some of my deals. I'm going to walk you through the house, show you the things we're doing to it so that you can get a first-hand view of how all that works. Now, if you'd love to hear, if you'd love to hear an amazing story, and it's truly an amazing story because the guy's name is Ian Flanagan, and Ian Flanagan was a wholesaler, and he was doing okay as a wholesaler, but he really wanted to take another chance. He wanted to move up through the tiers so that he could get to Tier 3, Tier 4. And he came to Alabama. He was a hairdresser out in Texas. He came to Alabama, spent 3 days with me in Alabama, and guys, he went home. Well, you know what? I don't want to tell all the story. So here's what I want you to do. You got to go hear this guy's story and go to realestatemasterinvestor.com. realestatemasterinvestor.com. Go to that page and listen to Ian Flanagan's story. And if it doesn't inspire you to go out and do more, I don't know what else will. Because the guy is a living case study of what can happen to you if you just commit to spending some time with me. And so I want to invite you guys to Huntsville. I want to bring you into my office, show you what I do here, take you out in the field, show you my deals, and really show you how we utilize private funding. So do me a favor, go over and listen to Ian's story at realestatemasterinvestor.com. Check it out, see what he's all about, and listen to his story and how the 3 days in Alabama impacted his life, okay? The other side of it is that we have the Inner Circle coming up this week, the Inner Circle training where I'm going to break down that case study of that deal. And to top it off, I still have another training coming to you next month, or next Monday. And that Monday is going to be some really cool online services that you guys can go to get what we call bridge financing. Well, what is bridge financing, right? I'm throwing out all these words, and some of you might be looking at me like I'm crazy. Well, bridge financing is this. So this is you. You're on this path. You found some money because you want to buy this house, right? Well, there's this gap here, right? And the gap over here is the fact that you've got to take this house and you've got to add an addition onto it. You know, you've got to put some landscaping in here. You know, you got to put a driveway in. You got to put some more landscaping in here. You got to remodel it, right? You got to remodel the house. Well, that remodel costs money. But over here, you got to purchase the house, right? And at the end of all this, you end up with what's called profits. Okay? So how do we get this bridge? This bridge is the gap we're trying to fill. Okay? So we need money. We need money to fill that gap. And that gap is from where either a private investor or a hard money lender had funded money to purchase, right? But yet we now have to remodel this house. So what does that mean? Well, we need money to remodel that house, okay? So I'm going to show you next Monday, on our Whiteboard Monday, every Monday, I'm going to show you next Monday how we get this bridge funding to fund the remodel of the house. Yes, that's right. Now, can some of our privates do it? Absolutely. But if you're using a hard money lender, you need bridge. So stay with us next Monday. Our next Whiteboard Monday is coming to you, and I'm going to walk you through on Monday how we use these services to get this bridge funding. But in between then, this week you got an Inner Circle training coming out. So you want to watch that all about the Turnbook property, and you want to see how we did that deal, how I went to the title company. I explained a little bit of it to you in the truck, that you'll see the video. I came out of the title companies with a check for $15,000 to go remodel the house with. No money down, right? Well, not quite no money down, but I want you to pay attention to the video because I'll break down where the money had to come from, and let's just say wasn't a lot, but you got to watch the video. All right, guys, this is Zack Childress with REISuccessCoaching.com, and looking forward to seeing you guys on some more of these videos. Whiteboard Monday coming to you from Zack. Remember, go visit realestatemasterinvestor.com to hear about Ian's story, and also remember we got another one coming out this week, Inner Circle Training, and we have our Whiteboard Monday next Monday. So I'll see you guys real soon.